现在还想开香港银行卡的，一定要抓紧时间了。
Today, there's major news about opening bank accounts in Hong Kong. Some friends from mainland China who tried to open accounts at Bank of China Hong Kong found the requirements have risen sharply. You need proof of studying or working abroad. You must have other overseas bank accounts. The minimum deposit must be $100,000. You have to sign a cross-border disclosure statement, promising all your funds come from legal sources outside mainland China. This effectively closes the account opening channel for mainland residents. Recently, Hong Kong's financial sector has experienced a huge shakeup. Mainland residents are being stopped from opening bank accounts, investing in Hong Kong or U.S. stocks, and conducting other related business. Since May 26, mainland investors opening new investment accounts in Hong Kong have been required to sign a statement confirming their funds come from legal sources outside China. One investor at a mainland-owned bank in Hong Kong said, "Halfway through the account opening process, bank staff stopped me. I had to sign a new document and restart the application." Some online users noted that Bank of China Hong Kong has always had the strictest requirements. HSBC and Hang Seng Bank still allow online applications for now. An industry insider gave a disappointing answer. Did you see the news? HSBC Hong Kong has now fully stopped mainland Chinese from opening accounts. Having a non-mainland identity is becoming more important. At least two sources confirmed HSBC now requires mainland investors to sign statements proving their funds are from overseas. For ordinary citizens on the mainland, this essentially blocks access to opening accounts. Despite tightened policies and negative rumors, people from the mainland are still lining up. On May 26th through 27th, many queued at HSBC, Bank of China, and other banks in Hong Kong. One user said, "HSBC queues look like 4 hours long." Another added, "There are at least 100 people handling business at the branch." This storm began on May 22nd, when China's securities regulator, along with 8 other departments, investigated iTiger, Futu, and Longbridge for operating securities business in mainland China without permission. The regulators announced fines totaling over 2.2 billion yuan. The announcement didn't specify how much of the illegal income would be confiscated, but estimates suggest total revenue for the 3 firms could reach 28 to 37 billion yuan. iTiger, Futu, and Longbridge serve mainland investors through cross-border internet brokerage. They use Hong Kong or overseas licenses and platforms as websites, apps, social media, and local partners to provide services for opening accounts, trading Hong Kong and U.S. stocks, and transferring funds. Over the past few years, they have attracted many middle-class mainland investors and young retail traders. On the evening of May 22nd, Futu and iTiger disclosed fines. Futu said the China Securities Regulatory Commission planned to impose a total penalty of about 1.85 billion yuan on the company, and recommended a personal fine of 1.25 million yuan for founder and CEO Li Hua. iTiger announced that several of its subsidiaries have received notices from the CSRC Beijing office, facing administrative fines totaling around 310 million yuan, with illegal gains of about 100 million yuan confiscated. On the morning of May 23rd, Singapore-based iTiger International issued a statement regarding the investigation. It said, "Recent claims that iTiger International refused to cooperate with regulators or challenged supervision are completely false. We formally clarify this." The heavy penalties on these overseas Chinese-backed brokers have sent shockwaves through the market. Futu founder Li Hua's personal wealth fell by more than a quarter. According to the Bloomberg Billionaires Index, Li Hua's fortune dropped by $1.7 billion to $4.7 billion as of May 22nd. Last October, his wealth reached $10.1 billion, so it is now less than half of that. Most of his wealth comes from his holdings in Futu, which is listed in the U.S. Futu is closely associated with Tencent. Li Hua, the largest shareholder, was Tencent's 18th employee. iTiger is backed by Xiaomi and other Chinese background investors. Founder Wu Tianhua is the largest shareholder, and Xiaomi is the second largest. Other investors include Tan Bin Sen, China Creation Capital, and Gen Fund. Longbridge Securities' founding team has a strong Alibaba background. Its founders and management mainly come from Alibaba. A key strategic shareholder is Yuanjing Capital, a well-known venture firm founded by former Alibaba executive Wu Yongming. Analysts note that these actions go beyond formal financial regulation. They reflect a systemic effort by Chinese authorities to block private capital outflows and strengthen a wartime system, with potentially even greater measures to come. Mainland internet users mocked the news.
又传来好消息了，香港证监会要求
Here comes another good news. The Hong Kong Securities and Futures Commission is raising account opening standards. Many chairmen suffering in China's A shares wanted to open Hong Kong accounts and trade US stocks to earn money easily. Now, it's almost impossible. We'll have to stick to the mainland market. No hope. Don't even think about going overseas.
Other comments said, the government not only wants to prevent capital outflow, but more importantly, it doesn't want ordinary citizens to lose trust in the country's future. This is a direct slap to the authorities. Some added, this proves a saying, if you could make money from stocks, you wouldn't even qualify to open an account. Many users discovered that platforms like Singapore-based and Hong Kong-based Yingli Securities no longer allow mainland users to submit new account applications through their apps. The Singapore Yingli Securities app now shows that users in mainland China cannot submit new account applications through the app. The Fosun app states it cannot provide account opening services to investors inside China at this time. Hong Kong Yingli Securities platform says mainland residents without residency documents from other countries or regions cannot submit new account applications through the app. Some mainland users reported that the Standard Chartered app prompts, "Sorry, thank you for your application." Before opening an investment account, you must register for a comprehensive monthly statement. For assistance, please visit a branch. The news is even more alarming for mainland residents who already have Hong Kong bank accounts. An industry insider said,
香港账户要彻底大清洗了，手里有港卡的。
There's a shocking announcement. Hong Kong accounts are about to undergo a complete cleanup. Anyone holding Hong Kong assets should check immediately. Friends in mainland China with Hong Kong banking accounts or investment accounts in Hong Kong or US stocks, your accounts could be frozen, closed, or forcibly terminated at any time within the past 2 weeks. This is not a joke. The vlogger warns that this cross-border financial crackdown isn't just targeting new accounts, it's now reviewing existing ones. Starting May 2026, many Hong Kong bank and investment accounts are entering centralized re-examination. Officials are tracing accounts back to January 1st, 2023. Any account opened after that, whether in use or holding funds, is subject to review. Accounts with incomplete documents, proxy setups, or false addresses, even if several years old, could be flagged as non-compliant. Many people have already received risk notices or requests for additional documents, and some accounts are restricted from trading. Long-dormant accounts with zero assets or no activity for 12 consecutive months are now a priority for closure or re-examination. Even if documentation is correct, accounts unused for long periods may still face closure or review. At the same time, the threshold for opening new investment accounts in Hong Kong has risen sharply. Banks now require applicants to sign statements declaring funds come from outside mainland China and to provide proof of overseas work, study, or bank accounts. Deposits and withdrawals must be linked to compliant overseas accounts. Any unusual cross-border transfers or third-party handling may trigger risk controls or account closure. Commentators note that while the penalties on cross-border brokers appear regulatory, this is actually a systemic financial crackdown aimed at cutting off mainland Chinese access to overseas markets and stopping capital outflows. Two major warning signals emerge. First, private property is not truly protected under the Chinese system. Second, the move suggests China's economic crisis may have worsened significantly, resembling a sweep-the-house-style regulatory action. Experts say that in recent years, more and more Chinese citizens have been investing in overseas stock markets. Last year, funds bypassing Chinese regulations to leave the country reached a record high. To control capital outflows, Chinese authorities have recently launched a crackdown on offshore trading platforms, which could reshape how Chinese people access foreign markets. For decades, China has strictly limited capital outflows. Individuals were capped at purchasing $50,000 in foreign currency per year, and only for overseas travel, education, or other non-investment purposes. Chinese citizens and companies could trade foreign stocks only through tightly regulated channels like the Shanghai-Hong Kong Stock Connect, the Shenzhen-Hong Kong Stock Connect, or the Qualified Domestic Institutional Investor Program. Retail investors could also invest directly in some Hong Kong listed stocks through the mutual recognition of funds mechanism. Any other overseas trading without approval is illegal. Since 2022, China has banned unauthorized overseas brokers from helping mainland investors open new accounts. On May 22nd this year, authorities accused Hong Kong's Futu Securities and Longbridge Securities and Singapore's iTiger brokers, three of the largest and most active brokers, of operating without a license in mainland China, imposing fines totaling $330 million. This means existing mainland clients of these brokers can only sell holdings and withdraw funds. They cannot make new purchases or deposits. Within 2 years, all websites, apps, and servers serving Chinese clients must be fully shut down. Currently, only Chinese citizens with permanent residency in Hong Kong or Singapore, or those holding investment or work visas, are temporarily exempt from forced liquidation. Data shows that last year, funds escaping China's capital controls reached an estimated $1.04 trillion, the highest on record since data collection began in 2006, sparking panic among authorities. Experts note that even after China's 2022 ban on overseas brokers soliciting mainland clients, private capital continued to flow out. To transfer wealth abroad, people used a variety of methods. Small transfers were made using the $50,000 annual foreign exchange limit. Large transfers relied on underground banks, over 100 of which were closed during a recent nationwide crackdown. All these channels rely on cross-border fund matching. Individuals pay local brokers in yuan, while overseas partners provide equivalent foreign currency, bypassing domestic banks. Another method is buying insurance policies issued by Hong Kong companies with yuan, then canceling the policies to receive foreign currency refunds. Industry insiders say that given the severe economic situation, while China cracks down on overseas broker platforms, it is also trying to guide capital back into domestic markets. For example, last year, authorities launched a large-scale tax action targeting overseas capital gains and other foreign income. These measures make it harder for ordinary citizens to move assets abroad, but they cannot fully stop larger-scale capital flight. There are two main reasons. First, no matter how hard Chinese authorities try, they cannot completely shut down underground banks. Many of these operations are effectively white gloves for local governments, with tangled connections to foreign trade companies, local police, and government interests. As a result, central directives reaching local authorities are often handled superficially, and actual operations are largely unaffected. Second, both ordinary citizens and corporate executives have completely lost confidence in China's economic and financial markets. This lack of trust is the most fundamental driver of capital leaving the country. On May 25, 2026, the mainland A-share market saw a rare scene. All three major indexes rose, but most investors did not make money. By the close, the Shanghai Composite Index rose 0.96%, the Shenzhen Component Index gained 1.66%, and the Chi-Next Index increased over 2%. On the surface, the market looked positive, but over 3,700 stocks fell. Nearly 70% of individual stocks ended in the red. Financial influencer Lao Ban Lianbo has over 6 million followers. He said this reflects growing divisions among domestic investors. Bulls concentrated on adding positions in tech stocks, while bears cashed out at highs. Funds were simply shifting internally, playing a game of tug-of-war. Another influencer noted that current trading is mostly about hype. Whether the technology can actually succeed is secondary. Capital remains heavily clustered in tech, while other sectors see little interest. This extreme divergence makes it difficult for ordinary retail investors to profit. Behind the lively market, the pattern reveals growing anxiety among domestic funds in the A-share market. Analysts say another core issue is that there isn't much new capital entering the market. The A-share market is still driven by existing capital, simply moving between sectors. Some investors commented, "Anyone who understands knows it's time to sell. This is the last frenzy." Meanwhile, China's Ministry of Commerce reports that in April, foreign direct investment, FDI, fell 26.1% year-on-year. Foreign investors continue to withdraw from the mainland. Holdings of Chinese bonds hit a 5-year low, and some international private equity firms are selling their China operations. Data from the Ministry of Commerce shows that from January to April, FDI denominated in yuan totaled 287.7 billion, down 10.3% from the same period last year. FDI refers to economic investments made by foreign companies in a country to gain profit, often forming multinational or international companies with local partners. The Chinese government views foreign investment as a key support for the economy. The ministry usually reports cumulative data from January to March or January to April, which allows outsiders to estimate monthly figures. April's actual FDI was 38.1 billion yuan, down 26.1% year-on-year and 56.7% compared to March. Additionally, data from China's central bank shows that after 12 consecutive months of reduced holdings in China's interbank bond market, foreign holdings fell to 3.12 trillion yuan by the end of April, the lowest since November 2020. According to the China Government Securities Depository Trust and Clearing Company and the Interbank Market Clearing Company, foreign investors reduced their holdings of Chinese government bonds by nearly 10 billion yuan in April. They sold over 20 billion yuan of policy financial bonds, the largest drop since July last year. They also cut more than 40 billion yuan of interbank certificates of deposit, bringing holdings to the lowest levels since October 2023. The Financial Times reported that stricter Chinese cybersecurity and data protection rules are making it increasingly difficult for foreign investors to hold digital infrastructure assets in China. Global private equity firms are now fully divesting from China's data center businesses, signaling the near end of foreign investment in China's digital infrastructure boom. Analysts say this data reflects a highly precarious trajectory for China's economy. All indicators are hitting new lows. This explains why Beijing is willing to challenge powerful insiders and their white gloves to crack down on capital outflows. However, these measures are unlikely to change the overall trend and may instead heighten public panic and strengthen the resolve to move money abroad.